This is Alan Bush with ADMIS. In the stock index futures, we did see some very severe declines yesterday. A couple of reasons for this. For one thing, we had Chinese economic numbers coming in on the weak side. Also, we did have a weak ISM report yesterday that caused a good portion of the pressure as well. We did see the lows that were made in December taken out, so there were quite a few sell stops hit apparently. However, with the sell stops out of the way now, traders starting to look a little bit more toward the earnings situation. Earnings, for the most part, have come in better than expected, as have revenues. So even though we have seen pressure over the last month or so, I think that this bull market is still a bull market, and this break that we have seen is only a correction. Over in the currency markets, we are seeing the pound under some pressure today. However, there has been a bounce in the British pound after a report showed that UK construction spending is likely to improve. So from here, I think we can see a gain from current levels in the British pound. Also, there remains the feeling that the Bank of England will be increasing interest rates next year. That, of course, is bullish for the pound. Seeing some weakness in the Japanese yen, as the emerging markets situation seems to be a bit on the back burner. At least there appears to be some progress in that situation. So the flight to quality status of the yen somewhat undermined with the yen weaker today. The big mover, however, is the Australian dollar, which is sharply higher. This after the Reserve Bank of Australia abandoned their two-year easy monetary policy, or at least their bias toward easier credit. So sharp gains in the Australian dollar. However, we are now up against resistance areas. From here, I think we can see lower prices from these current better levels. Still thinking that 85 cents is a good target level on the downside for the Australian dollar. And interest rate markets, flight to quality longs being liquidated as the emerging market situation seems to be alleviated to some degree. However, we do feel that economic reports here in the U.S. are likely to come in a bit on the weak side over the next couple of months. And in a minority view, which we hold, we feel that the Fed will be forced later this year to halt the taper. And of course, any halt of the taper could be construed as somewhat friendly for treasuries. But I think that is a situation that is likely to take place in the second or third quarters of this year, as far as the Fed halting the taper, or what I would call tapering the taper. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.